Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to the Equity Mates community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. There is so much happening in markets. It is moving at a head-spinning pace. Sometimes you need an antidote from that. Sometimes you need a 94-year-old man to sit you down and tell you to focus on what's important and let the noise pass through.
Yeah, we'll get to it.
And that's what we got over the weekend when Warren Buffett released his annual letter. So in this episode, we're going to unpack what he said and what we've learnt from his 60th letter, I imagine, if you've been writing them since 1965. Maybe his 61st, actually.
Probably.
If it was 65 inclusive. Anyway, I'm just killing
You're
time
rambling,
here. But that's not all we're going to talk about today, because we also have Luke Laretive from Seneca Financial Solutions joining us for Pimp My Portfolio, where he reviews the portfolio of an Equity Mates community member. But before all of that, Bryce, let's get into the news of the day.
News and markets.
We're going to start with some news that has been making headlines for a while now, Ren, and that is WiseTech. The saga is continuing. It is going to be one of the most remembered in a long time in Australian corporate history. Multiple personal allegations are surrounding founder Richard White. He's stepped down as CEO last year, but did remain the largest shareholder of the company. I think he holds about 40% of the stock. However, the latest development in this story that's playing out is that 3 of the 5 independent directors have resigned, citing differing views around the ongoing role of the founder. I think he's on $1 million salary and is not a contractor, a consultant with still a lot of the shares. Obviously still has a pretty integral role, and the stock plummeted 20% on the news. Yeah,
it's a funny one. It's like I think it's a reminder for a lot of Australian investors. Like, this is the duality of founder-led companies that, like, you got to take. I'm not saying whether his involvement in the company remains good or bad, but you've got to take with the good with the bad. Like, founder-led companies, there's a lot of reasons why you love them. Perhaps incentives are better aligned between small shareholders and the management and executives in the company, but you also then are subject to the control of the founder. And in this case, it's a reminder that even when Richard White steps down as CEO, as someone who owns, I think, just shy of 40% of the company, like, he still holds the reins.
Yeah, big time.
All that matters is who owns the company, who owns the shares.
Yeah.
CEOs, board members all act at the whim of the owners. That's the reminder from this story.
That's right. Stock's down 22% year to date. Maybe one to put across Mr. Beat-Up's desk and get his views.
Yeah. Well, Bryce, if WiseTech will be remembered in Australian corporate history, this next story is about Australians making history.
Okay.
Let's talk about quantum computing.
Let's do it.
And how Australia is at the forefront of what is happening there.
Well, Australia's Silicon Quantum Computing, which is a startup led by 2008 Australian of the Year Michelle Simmons, they've set a new record in a key quantum computing benchmark. Their chip has sold Grover's algorithm, which is a test only quantum computers can complete, with a record-breaking 98.9% accuracy. A huge development. We actually listened to Michelle Simmons at the Hearts and Minds a couple of years ago, and it was fascinating what they are doing.
Yeah, can't say I really understand quantum computing, but I can understand enough, and I can understand the excitement of technologists enough to know that, like,
it's a big deal.
This is going to change everything.
Yeah.
NVIDIA, Jensen Huang said, it was about 10 years away. And then Google came out late last year, early this year, and they had they announced a breakthrough that they thought accelerated the advent of quantum computing. This week, Microsoft came out with a new chip, the Majorana one. Too much like Monjaro, to be honest.
Yeah.
They created a new state of matter. So if you think back to your year 8 science classes, matter can exist in 3 states: solid, liquid, gas. Not according to Microsoft. They've created a topological qubit that they claim is a new state of matter. You're going to have to ask people smarter than me about what state it exists in. But what I can tell you, Bryce, is Microsoft have created a new state of matter, and they're still underperforming the S&P 500.
Doesn't matter.
Of their Mag 7 peers.
How are you going to monetize that?
Of their Magnificent 7 peers, all of them are killing it. Even Apple is up over the past year. Microsoft down 1% over the last year.
Over the last 12 months?
Over the last 12 months.
Wow.
Yeah.
Wow. I'm sure Google's not far behind, to be honest. Year to date, down 5%.
No, not year to date, over the past 12 months.
Oh, okay. Yeah.
Yeah.
Massive underperformance.
You know, Apple, everyone talking about how it's struggling and it's had to release a cheap iPhone because no one cares about Apple Intelligence. It's still up 36% over the past 12 months. Microsoft's been a real laggard.
Gosh.
Opportunity.
Anyway, we'll keep an eye on what's going on in the world of quantum computing because, as you said, Ren, technologists certainly get very excited when these breakthroughs keep coming. You may have heard of MicroStrategy, a company led by Michael Saylor, who recently did a brand change from MicroStrategy just to strategy with the small Bitcoin B on the end.
Oh, I didn't realize that.
Yeah, he's got the little Bitcoin B at the top.
But that's not part of the name, is it?
No. Okay. I think their logo has it involved.
Who do you reckon? Who came up with the Bitcoin B? Because they should have trademarked
100%,
that.
yes.
Yeah. So Strategy has amassed 471,000 Bitcoin, which is about 2% of all Bitcoin that will exist.
Yeah, it's wild.
Because it's 21 million is the amount of Bitcoins that will ever exist.
Yeah. Yes. And so the strategy for them is just to continue raising capital and buying Bitcoin. Their market cap is $87 billion, which is nearly double the value of its Bitcoin holdings.
I think that's an important thing to note.
Yeah. However, what we've seen is a trend around the world of other corporates doing the same thing, completely changing their business strategy away from their core business to just a Bitcoin reserve.
And the reason for their strategy, which I don't think we actually said when we were speaking about MicroStrategy or strategy, is it's up 250% in the past year and 2,000% in the past 5 years.
Yeah, so no surprises. Other companies want to get on board. In fact, 78 companies from around the world now also hold cryptocurrency on the books.
Yeah. Now, there are some examples that are less outrageous. Some just have bought a little bit of Bitcoin to diversify their treasury. But then there are some which are pretty outrageous.
Yes.
Some which potentially have taken a business that is struggling and said, maybe we can turn this around by just buying Bitcoin. So here's a few examples. So Japanese company MetaPlanet last year switched from their core business, which was developing hotels, into just buying Bitcoin. Share price is up 2,000% since then.
Wild. There's One MedNet, a 30 mil market company specializing in healthcare data. They've used $4.6 million raised through a private stock sale to go and buy a Bitcoin in order to fight back against some of their short sellers, i.e. pump the share price.
Yeah, which is actually, I kind of love that strategy. It's like people are shorting you, so let's squeeze them. What's the best way to squeeze them? Not by slowly raising earnings over time, but just buying Bitcoin and letting the hype do its thing. What about this one, Bryce? Semler Scientific. They bought 871 Bitcoin using about $90 million, and they did the Michael Saylor strategy. They raised with a convertible bond, so they raised in fiat currency, and they bought Bitcoin, which is what Saylor is doing as well. Shares are up 120% since then. Or how about this one? KULR. Their core business, they provide thermal energy management products for NASA and the US Navy. So on rockets and ships and planes. You know, that's a pretty good business.
Yes.
But they decided not good enough. They bought 510 Bitcoin Since then, the share price is up 117%.
That's unbelievable.
And one more for you. This was the most surprising company.
Yeah.
Alliance Resource Partners, known for their coal mines in the Appalachia region of the US, they've decided to get in on the Bitcoin game as well.
Interesting. So if I'm listening to this as an executive with some bonuses on the line that is purely tied to share price growth, I know what I'm going to be doing.
Now, the interesting thing for me is you mentioned that market value is about double the size of their Bitcoin holdings.
Yeah.
If heaps of companies do this same thing, and it's like all of a sudden there's competition amongst treasury, Bitcoin treasury companies, you would expect that premium to fall.
Why though?
Because really, like if you weren't thinking about strategy as a company and you were just thinking about it as a listed investment company, you would expect you would expect it to trade close to its net asset value.
Yeah.
And it trades at a premium to its net asset value because of the hype and the marketing, but also because of the scarcity.
Yes. Yeah.
And as more options come to market, Bitcoin ETFs, but also all these other Bitcoin treasury companies, there will always be a Michael Saylor premium. There will always be like strategy is the name brand. It's so big. He's so prominent. But double?
Yeah.
You know, trading double the net asset value?
Yeah.
And also, like, I would argue that the amount of debt that strategy has there should maybe be some risk built into that price.
Yeah, but we know what I guess some of the views are of these crypto guys, and they get behind them.
Yeah. Anyway, I think every crypto hype cycle is slightly different.
Yeah.
You know, like 2021 was NFTs.
Yeah.
This one has been shitcoins, but I think what we're also going to see is this one's been shitcoins and governments rug pulling their citizens. Argentina, Central African Republic, Trump and Melania. But I think also this Bitcoin treasury company is going to be another trend we see. I guess in 2021, we also saw companies put blockchain in their names.
Yeah, that was big.
Do you remember like the Long Island iced tea company? Yeah.
Big time.
Whereas this one will be, we're just going to give up whatever business we've been running and just buy
check out our
Bitcoin.
reserves. Anyway, if you would like to keep up with more of the news headlines, make sure you're subscribed to our daily newsletter. There'll be a link in the show notes to do so. We'll send you a condensed summary of the most important business headlines from around the world every morning, 6 a.m. But if you like listening to the headlines rather than reading, good news is we've turned that newsletter into a podcast as well. It's called Headlines by Equity Mates, and you can listen to the news headlines in less than 5 minutes. It is time for
Pimp My Portfolio. Pimp My Portfolio.
We have an expert in the room, Luke Laretive. Luke, welcome.
Bryce, Ren, let's dance.
And we have a listener on the phone who has submitted their portfolio for Luke to review and provide some feedback. On the line, we have Joe. Joe, how are you?
Yeah, pretty good.
Now, Ren, as always, do you want to take us through Joe's portfolio?
Yeah, so Joe has quite a concentrated portfolio of individual stocks. We've got 8 companies. Pro Medicus is the largest holding at 40%. Then we've got the payments duopoly, MasterCard and Visa, coming in at 23 and 16%. Mercado Libre, the South American e-commerce player, at 12%. And then we've got some smaller holdings to round it out. LVMH, Intercontinental Exchange, Meta and Chipotle, all about 2 to 3% weightings in the portfolio. So Luke, 8 stock portfolio from Joe, all global shares bar Pro Medicus.
Quite interesting.
What's the nickname?
The nickname is filter sort ROE. So if you're on Excel and you put on the filter and then you go sort and then you sort by largest to smallest ROE, that's what I feel like young Joe's done here, and just build his portfolio by looking for the highest return on equity companies around the world that he can find. Is that correct, Joe?
Well, sort of. Like the way this portfolio came about, basically you have to understand it, you have got to go all the way back to the GFC, because I bought some stocks during the GFC, 2 of which are like the OGs, as you would call them, which are MasterCard and Visa, as well as some other equities. And then around 2013-14, when I was finishing school, I sold some shares in TPG and a few other ones because the portfolio had accumulated quite a bit. And then because it was too big, we split it into two portfolios, and the other one, my mum sort of now handles that bit of it. And that's more like with an Australian focus, although it does have some global equities. And then the second one, which is the one you're probably looking at and is on the show, was because, I wasn't satisfied with Australia and I'm greedy and I want to buy, great shares all around the world, basically.
Okay.
Nice.
Well, if you bought Visa and MasterCard around the GFC, Visa's up about 2,000% from there and MasterCard's up about 3,500% from there.
But let's make the point that matters for today, which is not telling Joe how clever he is, but how dumb he is. Because the reality is that Visa and MasterCard are 89% correlated over the last 10 years and 91% correlated over the last 5 years. So they are effectively the same company. Right, so they move together. Those returns are about as correlated as you can get for two stocks. So I would not saying sell either, buy either, whatever. I'll just be thinking about it as 28% of my. 30% of my portfolio.
40, yeah.
Well, it's actually 16% Visa, 23% MasterCard.
So what's that, 29,
40%.
40% of my portfolio is correlating together, right? So I'm always thinking about trying to generate returns from, diverse source of things that are kind of low correlated. Equities, it's hard to be negatively correlated, but you want lower correlations among stuff. All making you money at the same time, ideally, but for different reasons, if that kind of makes sense. More idiosyncratic reasons. If we're going to pick stocks, we want to be picking stocks for idiosyncratic reasons, for unique reasons, nichey little things. So that's just something to keep in mind.
Yeah, so you can 35 bag a stock and Luke can still find a problem with it.
But the question is what are you doing today with the money?
Yeah, I know.
That is the thing. Like, well done, you've got money. Heaps of people do. Congratulations, let's go. The point is what can you do today to make more? And how can you ensure that you're outperforming in the future? And from my perspective, I'm always thinking about, not just outperforming in absolute numbers, but thinking about, risk and risk-adjusted returns. And I think when you're managing significant amounts of money, which sounds like this potentially could be, that's the kind of attitude you want to have. So I don't know about your mum's portfolio or whatever, not sure about that one, but you want to if you're going to run a high conviction portfolio, like 15 or 20 companies, like bare minimum. And like 5 sectors, 4, 5, 6 sectors at least, like when I'm talking sectors, I'm talking about GICS sectors.
Yeah. For people that don't know what that means, you mean like
just
materials, industrials, technology,
defined sectors.
Real estate, blah, blah,
retail,
blah, blah, blah. Yeah, correct. So
again, just diversification.
Yeah, basic diversification. Nothing wrong with running concentrated portfolios, but I didn't bother going and doing the, correlation covariance matrix for your whole portfolio, but I bet you it all would be really correlated.
So I think there's one aspect which is portfolio construction, which Luke is talking about here, and then we'll talk about the stock picks themselves. But just holding on portfolio construction, when we said that Pro Medicus was 40% of the portalio, I thought you'd jump in there, but you haven't. So
I was waiting. I was waiting. I was like a snake in the grass.
So talk to us about portfolio weighting.
Yeah. Okay. So you need to just keep your stock, your biggest weighting in your portfolio, like 15%, 20% max. That's it. One company max. Even that just makes my eyes water.
Why?
Because you need to be properly diversified, and the best stock pickers in the world have 50, 55, 45% win rates.
What if the best opportunity to do with your money though is to keep it in there?
How do you know it's the best opportunity?
No, it's just the risk is too high that you blow up.
The risk is that you're wrong. That's the risk
of your portfolio, or even that you're right but the market disagrees with you for too long.
Yeah. So look, the math don't lie here, right? Like let's say that your really good win rate, you're 55%. Like your top win rate globally, 55%. You're still 45% chance that Pro Medicus is going to underperform. Now you might be right, you might be wrong, but the reality is that the math says that you shouldn't be so high conviction. So that's why we do it. So is PME a good business? Yes. Is it trading on 200 times earnings? Yes.
No, it's actually trading on 350 times earnings according to Google.
Yeah, but that's because you're reading last year's earnings.
I know, it's just a bigger number.
I'm talking about forecast earnings. It's on 208.9.
Forward earnings.
Yeah, forward, 1 year forward, right? On the basis that they can continue to win market share in what the world sees as a global, increasingly addressable, growing addressable market. Market share wins do not go on forever. Margins do eventually cap out. They're already at 70% just for for those playing at home. Growth eventually slows. Monopolies eventually either get regulated or get disrupted. It's inevitable. So it may not be tomorrow. It may not be next year. Maybe in 10 years' time. I may be massively wrong about this, and this might grow faster than everybody expects. But I don't think I am. We don't own Pro Medicus. I don't want to own it. Would I short it? Tempting, but I wouldn't.
But again, that's not because of the quality of the company. That's
Good
just
business.
because of the...
But a piece of bread, sourdough from the best baker in the world. It's only worth so much. One slice of bread, right?
I don't think we need the bread analogy to understand
but
valuation.
Do you know what I mean? Like everything's got a price.
So we got a lot to cover here. So I just want to close out portfolio construction on the flip side. So that was some of the bigger weightings, but Joe also has some smaller weightings, 2 and 3%.
Fine with that.
Are you fine with that? Yeah.
Yeah, I think theoretically, if you can make enough picks and you can, one's fine. One's actually okay.
1%.
Especially like a starter weight. We do that sometimes. Like we like something, we want to do want to do more work on it, but we'll put it in at 1 or 2, and then but the goal is to get it to 3 or 4. And if we don't get it to then we'll sell it. We'll get rid of it altogether. If you it looks pretty good, but I'm not all the way home conviction yet, but I don't want to miss something, or I've got a catalyst that I want to get involved in or whatever, or I've got some lazy cash that I want to get back in the market. Sometimes you'll just do a little starter position. So yeah, I don't mind the smaller weight stuff. It's more the 23s and the 16s and the 40s that give me heart palpitations, especially when they're 90% correlated to each other.
Fair enough.
Nice. So, Joe, let's turn to some individual stocks. Are there any stocks in particular that you want to ask Luke about?
Well, Pro Medicus, I know, it brings back memories of Domino's, because I used to have that one, and I remember I sold that also. But the reason behind Visa and MasterCard I picked them is because I wasn't initially sure. I mean, this was going back when I was still in school, so I didn't know which one was going to work out so well. But the one that the two that really sort of concern me are LVMH and Mercado Libre, because I'm not really sure, what your thoughts are on those two. Those were the ones I really wanted to know your opinion about.
Yeah, as much as I would love to give you a view on those stocks, I've got a view, but at the end of the day, I know that I'm not an expert compared to every other analyst on the planet who covers those companies, right? So, I can give you a pretty red hot view on Pro Medicus. I can give you a pretty hot view on any other ASX listed company that's, notable, but it's really these days. I used to we've owned LVMH for clients back in the day when we used to do global equities direct, but these days I don't buy direct global equities for clients anymore. So we just buy managed funds for people because there's specialists out there who are better at picking stocks than me. So as much as I would love to tell you that it's all going to turn around at LVMH and, the luxury recession is going to turn around or whatever, maybe. I'm not sure. They're all good brands. They've all got historical good businesses. I think if you held them for long enough, you probably do fine.
Yeah.
It's not. I don't really have a competitive edge on any of those companies.
Yeah, fair enough.
Sorry.
Well, look, I think Luke started the conversation by giving it the nickname filter return on ROE. But, one of the things that you're looking for in good companies are companies that can earn a high return on equity. So you're not too far away, Joe. Think about your portfolio construction, the portfolio weights, and if you find the next Visa or MasterCard that will 35 bag over 15 years,
like well.
Just shoot us a message, would you?
No worries. I'll do my best.
Nice one, Joe. Well, we'll leave it there, but thank you so much for submitting your portfolio. I hope you managed to get a few things to think about from Luke there.
Yeah, no worries.
We do really appreciate it.
Thanks, Joe.
Thanks, Joe.
If you'd like to submit to Pimp My Portfolio, you can head to equitymates.com/contact. There'll be information for you to do it there. Additionally, if you would like to chat to Luke or any of the other advisors in our network for either investment purposes or holistic advice, you can go to equitymates.com/advisors, and there will be a form as well for you to fill out, and we'll be able to connect you with the most appropriate advisor. So make sure you head to equitymates.com/advice. I said advisors before, but it's advice. But Luke, as always, absolute pleasure.
Pleasure, boys. Appreciate your support.
Thanks, Luke.
We're going to take a quick break, and on the other side, we're going to unpack why Warren Buffett is sitting on $334 billion in cash and what he said in his latest investor letter. We'll be right back. $334 billion in cash and counting. Warren Buffett's annual shareholder letter is out, and here is what we learned.
Yeah, so 6 big takeaways from us. We'll include a link to the full letter in the show notes if you want to read it in full. But if you don't want to read it, stay tuned. Here's what we've learned. Number 1, Berkshire Hathaway, Warren Buffett's company, beat the S&P 500 again.
Just in 2024, Berkshire returned 25.5% compared to 25% for the S&P 500. Regardless of what you say, that is beating the S&P 500. But it's...
I mean, yes, it is. It's factual. But look, since 1965, here's where the numbers get interesting. Berkshire has almost doubled the returns of America's benchmark index, 19.9% a year for Berkshire, 10.4% a year for the S&P 500. Now, if you had had $1,000 and invested it in the S&P 500 in 1965, that would be $379,000. That's pretty good. $1,000, one investment, no dollar cost averaging.
That's all right.
That's pretty good.
Yeah, it's good.
But if you had invested it in Warren Buffett's Berkshire Hathaway as he took over that failing New England textile mill, that $1,000, $53.6 million.
That is wild. That is the power of compounding. And that is why when we went to the annual shareholder meeting in Nebraska a few years ago, there are people in that crowd who bought, I think, in 1965 and are multi-millionaires, and just love every word he says.
So that's the first takeaway. The second one is investing is about business and business is about people. I think what's really noticeable in this letter is what isn't there. There's no investing metrics. There's no where's the 200-day moving average of the S&P 500. There's no what's the price to earnings ratio for the S&P 500. There's no overall macro investing chart. It's all about the companies that he's investing in, and his companies are all centered on the people that he's backing to run those companies well. And there's a few stories in there that we thought were pretty interesting.
So the first one, Ren, is Pete Leigel. He runs Forest River, an Indiana RV maker. He's invested in so many businesses. Berkshire bought this business back in 2005.
The interesting story in the letter was when he bought Pete's company, he asked Pete, "What should I pay you? Whatever you say, I'll pay you."
And what did Pete say?
What would you say?
Shit, whatever you say, I'll pay you. I'd have some sort of profit share, I reckon.
Well, Pete's wife and daughter were also in the room, a lot of pressure to get this number right. Apparently, he had looked up what Buffett pays himself, and he said, "Well, I can't get paid more than my boss, so pay me $100,000 a year because that's what Buffett pays himself. But give me 10% of all profits above today's level." Yeah. So I reckon Pete did pretty well for himself.
He's done pretty well. So then there's Ben Rosner, who was a retailer that ran a business for Warren and Charlie. Ted Combs, who reshaped Geico in a major way. And then you can't go past Ajit Jain, who runs their insurance business, which has blossomed under his leadership. Buffett has said he turned an obscure Omaha-based company into a world leader renowned for both its taste for risk and its Gibraltar-like financial strength.
Nice.
Yes.
So third takeaway from the letter was operating profits were up 27% in a year. Pretty good for a slow and boring business.
Yeah, solid.
So the interesting dynamic here is you mentioned earlier how many businesses they own. I think it's 189 wholly owned businesses now. 53% of those businesses saw profits fall. So that doesn't seem like the setup for a good year.
Yeah.
But despite that, operating profits across the conglomerate increased 27%. And if you look at the breakdown, it's really been driven by two key areas. The first one is insurance, where profit close to doubled. And the second is investment income from insurance. Now, you mentioned in the second takeaway that Todd Combs reshaped Geico in a major way. That's, I think, a large driver of this insurance profit.
Yeah.
And then the insurance investment income is they have so much cash on their balance sheet. They're holding a lot of it in treasuries and they're getting more income from those as yields rise. Yeah.
Well, the big numbers continue. Lesson number 4, 5% of all US corporate tax is now paid by Berkshire Hathaway. And Buffett does not shy away from this. He's incredibly proud of the tax he pays. They paid $26.8 billion in corporate tax last year, more than any company has paid in US history.
Which actually surprises me because it means that the US government only collected $500 billion in corporate tax last year. I say only, but I just would have expected it to be a lot more.
Why do you say that?
Well, because they run like a multi-trillion-dollar budget. If they paid 5% of all US corporate tax, then they paid 26.8.
Yeah, but isn't this the whole thing? None of them pay value tax. They're all off in Ireland and
yeah. All right, separate conversation.
That's why I think his commentary here. I think he's like somewhat alluding to that.
Yeah.
It's like America's done well by me. I'm doing what I should be doing.
It is interesting how many finance people idolize Buffett, but don't idolize or don't take this part of him to heart, which is we have a collective responsibility to contribute. There was some quotes in here that people thought he was maybe subtweeting Donald Trump. He had this this passage. So thank you, Uncle Sam. Someday your nieces and nephews at Berkshire hope to send you even larger payments than we did in 2024. Spend it wisely. Take care of the many who, for no fault of their own, get the short straws in life. They deserve better. And never forget that we need you to maintain a stable currency, and that result requires both wisdom and vigilance on your part.
Yeah. Maybe a little
read into that what you will, I would say.
Lesson number 5, which is the headline, is that Berkshire is now sitting on $334 billion in cash. The number keeps getting bigger year on year. The speculation as to why it keeps getting bigger year on year. I like the theory around the estate planning and getting ready to buy back his stock if he does pass away. But look, he puts it down to the opportunities aren't there for him at the moment. But yeah, it is a shitload of cash.
So I think to put it in context, I saw this on our Instagram. In November 2023, we did a chart roundup, and we had a chart roundup of Berkshire's growing pile of cash, but it had surged to 157 billion. And that's in November 2023. So 18 months later, and we've more than doubled, and we're at 334 billion.
The cash he's getting from dividends alone is wild.
So it's threefold. It's the operating profits of the businesses. So, as we said, rose 27% last year. It's the cash from dividends. Like the dividend he gets from Coca-Cola each year is more than his original investment in the company. And then the third thing is he's actually been a net seller of stocks. Like he's been selling down. Not heaps, not enough for it to be like, oh, there's trouble here. But he sold, a fifth of his Apple stake. He sold some of his banks. And so he's not doing anything with it. Yeah. And even so for people unfamiliar, my estate planning theory is that he is about to execute the ultimate buyback on his death, because that's we can go into it in some other time, but I think it's quite an elegant use of his money. It's really fair to Berkshire shareholders. Yeah. But his net worth is only 150 billion. And I say only because in relation to that pile of cash, they could now do a buyback of his whole holdings of Berkshire Hathaway and still have 200 billion in cash.
I know. It's crazy. Anyway, we're super interested to see how that plays out. But to close out, lesson number 6 is that Buffett absolutely nailed the Japan trade. So to read from his letter, he said that a small but important exception to our US-based focus is on growing investments in Japan. I think they have about 6 businesses or 5 businesses that they invested in. So there's Itochu, Marubeni, Mitsubishi, Mitsu, and Sumitomo. All pretty large enterprises, all based in Japan.
Yeah,
so done pretty well from it.
They're all Japanese holding companies, or they're called trading companies, but they essentially are like Berkshire. They're like mini conglomerates, or some not so many, that own a whole bunch of different operating businesses. I think Buffett likes their management style, and he's obviously been increasing his stakes in them for a little while. But I reckon the way he's nailed it, and the particular elegance of the Buffett trade, is Japanese interest rates are so low, like close to zero, basically. And so what Buffett and Berkshire have done is they've gone over to Japan and raised debt in the yen. And then they have used that money to buy shares in these Japanese companies. And so what that has meant is that they're just less exposed to currency fluctuations. But what it has also meant is that their interest cost on their yen-denominated debt in 2025 will be $135 million. The dividends alone they receive from these 5 trading companies, $812 million.
Cash pile.
Yeah. So just like a really elegant way to take the yen risk out of the trade and just, I guess, really arbitraging the lower interest rates over there.
Yeah. If you'd like to read the letter in full, we'll put a link to it in the show notes. And a reminder, he has all of his previous 61 letters available on the very simple Berkshire Hathaway website. No design on that at all. Anyway, that brings us to the end of today's episode, Ren. Great to chat stocks. If you take a lot of value out of what we do, we would really appreciate if you could leave a rating and a review right now in your podcast app. Shouldn't take more than 2 minutes. It does really help us get in front of new Equity Mates audience. But always great to chat stocks, Ren, and we'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.